Growth stock is the stock of a company which is still in its early stage of growth. These companies are usually growing at a significant pace currently and have a strong potential for future expansion, hence the name growth stock. However, many of them have yet to reach positive profitability and may require a certain amount of time before they start earning a positive net income. Notable growth sectors include technology, biotech, fintech, renewable energy, and so on. Investors buy growth stocks with the expectation that the company's revenue and earnings will grow at an above average rate compared to the broader market. Hence, investors generally are willing to pay more to own these stocks, which increase the valuation of growth stocks such as a higher PE ratio. However, since growth stocks are often priced based on future expectations rather than current fundamentals, they can be more volatile and sensitive to changes in investor sentiment or economic conditions. Hence, growth stocks are generally considered to have higher risk compared to value stocks. So, if we identify 50 to 100 stocks that have consistently outperformed the market in terms of earnings and share price and purchase 10 of them from the list, does it make a guaranteed successful stock portfolio? The answer is not that simple for two reasons, according to Bangram. First, common stocks with good records and apparently good prospects sell at a relatively higher price. Investors might be right that the company has a strong future profile, but he needs to pay in full, sometimes overpay for the expected prosperity of the company. Second, the investor's judgment as to the future may prove wrong. Usually, rapid growth cannot keep up forever. When a company has already achieved some remarkable growth story, it is usually very difficult to repeat the kind of success again. At some point, the growth curve flattens out and in some cases, it turns downward. A stock's market price mainly consists of two components. First, the underlying intrinsic value of the company. Second, the market's expectation on the stock's future potential. For value stocks, the former outweighs the latter, but in the case of growth stock, the latter carries more significance. The more enthusiastic the public grows about it, the faster its advance as compared with the actual growth in its earnings, the riskier a proposition it becomes. It's not unusual to witness a growth stock plummet simply due to a slower pace of growth as people's expectation drops. Historically, many studies have shown that value investing tends to outperform growth investing over long periods. Value stocks, which are typically priced lower relative to their fundamentals, have often delivered strong results as they revert to fair value. However, more recent data shows that this trend has changed. During the first decade of 2000s, value stocks indeed outperformed, largely due to the tech bubble burst and the 2008 financial crisis, which hurt many growth stocks. Yet, over the last decade, growth stocks, particularly in sectors like technology, have significantly outperformed value stocks, driven by low interest rates, rapid innovation, and investors' appetite for future earnings potential. In conclusion, while growth stocks offer the potential for higher returns driven by future earnings expectations, they come with higher risk due to market volatility and investor sentiment. The success of a growth stock portfolio is not guaranteed, as paying high price for anticipated growth can lead to overvaluation, and rapid growth may not be sustainable over the long term. Historically, value stocks have outperformed over extended periods, but recent trends show that growth stocks, particularly in tech-driven sectors, have dominated due to low interest rates and innovation. Balancing these two investment styles requires careful consideration of both risk and reward.